Welcome to the Deep Sleep Science channel. Tonight, we're going to gently explore something that shapes almost every moment of your life, yet most people never truly understand it. The money in your wallet, the numbers in your bank account, the quiet transfers happening while you sleep, all of it is part of a vast invisible system built on trust, time, and hidden rules. Did you know that most money isn't actually physical? Or that banks can create new money simply by making loans? Or that a small shift in interest rates can quietly change the entire rhythm of the world's economy? As you listen, you'll begin to see how money flows like a calm, unseen current beneath everyday life, connecting people, places, and moments across time. So before you drift off, take a soft moment to like, subscribe, or leave a comment, and then allow your mind to slowly unwind as we follow the quiet story of how money truly works. At its heart, money works because it turns trust, accounting, law, and time into something people can use every day. A piece of paper, a number on a screen, or a balance in an account has no magic by itself. It becomes powerful because people agree that it can be used to pay, save, compare value, and settle obligations. In that quiet way, money is one of the most important shared agreements in human life. Money is not only something people hold in their wallets or see in their bank apps. It is also a vast system of connections that societies build and maintain together. Behind every simple purchase are laws, institutions, records, networks, and promises, all working in the background. What feels ordinary on the surface is supported by an enormous, invisible structure. Most money in modern economies is not physical cash at all. It exists mainly as balances recorded in bank accounts, moving silently through digital systems. That means the money people use most often is really made of information stored in ledgers, computers, and institutional records. The paper form is familiar, but the larger part of money today is digital and account-based. In modern banking, new money is often created when a commercial bank makes a loan and credits the borrower's account. The borrower now has spendable funds, and the banking system has created a new deposit at the same moment. This surprises many people because it means money is not always moved from one person's savings into another person's hands. Often, the act of lending itself expands the amount of money in circulation. That new loan creates a new deposit at the same time, which means lending can increase the money people hold in deposit form. The borrower can spend that newly created balance, even though it did not come from a stack of cash waiting in a vault. In this sense, the modern banking system can grow money through credit. The simple act of making a loan can reshape the money supply. Banks do not mainly work by taking existing savings and passing them along one-for-one to borrowers. In practice, lending itself creates deposits, and then banks manage the funding, reserves, and risks that follow. This is very different from the old simplified picture many people imagine. The real system is more dynamic, more flexible, and more dependent on confidence and balance sheet management. The older textbook idea that banks first gather deposits and then mechanically multiply them into loans is not the main way modern money creation works. Real banks are limited less by that simple story and more by profitability, regulation, liquidity, capital, and borrower quality. So the creation of money is tied to judgment and risk, not only to a fixed formula. Modern banking is much more about decision-making than mechanical multiplication. A payment network without trust fails, but trust without settlement infrastructure also fails. For money to work well, people must believe in it, and the system must also be able to move and confirm payments reliably. Belief alone is not enough, and machinery alone is not enough. Modern money needs both shared confidence and a functioning framework beneath it. Central bank reserves are a form of money too, but they are mostly used by banks to settle with one another, rather than by households in shops. When banks move money between themselves, these reserves help complete the transfer. They are like the inner layer of the monetary system, mostly hidden from daily life. Ordinary people rarely touch them directly, yet they help support almost every digital payment. When a payment moves from one bank to another, the two banks usually settle using reserve balances held at the central bank. This is one reason central banks matter so much to modern economies. They are not only institutions that set interest rates. They also stand at the center of the final settlement system that helps banks trust one another's payments. A payment is only truly complete for the system when settlement is final, meaning the receiving institution can rely on it without later reversal in the normal course of business. That finality is one of the quiet foundations of financial stability. If payments could never be trusted as truly complete, trade and banking would become far more uncertain. Final settlement gives money a sense of firmness. Money works across time by linking present claims and future obligations. A loan made today may be repaid years later. A salary earned this month may be saved for a future emergency. A pension contribution may be meant for decades ahead. In this way, money is one of the main tools human beings use to connect the present with the future. Interest rates show why the timing of money matters so much. A dollar today and a dollar many years from now are not economically identical, because money available now can be used, invested, or protected in ways delayed money cannot. Time changes the usefulness of money. Interest is one of the main ways economies measure that difference. Inflation explains why the same amount of money can mean different real things in different years. A balance that once bought a basket full of essentials may later buy less if prices have broadly risen. So money is never only about the number written on it. Its real meaning depends on what that number can actually do in the world. Exchange rates explain why the same amount of money can mean different things in different countries at the same moment. One currency can buy more or less of another, depending on the price between them. That means money has both a domestic life and an international life. Crossing a border can change the meaning of the same amount of value. The future of money may include central bank digital currency, which would give the public a digital form of central bank money, rather than only private bank deposits. That idea is important because it could reshape how people think about cash, payments, and public trust in digital money. It is not just a technical project. It is part of a larger question about what public money should look like in an increasingly digital world. One attraction of a digital central bank currency is that it could carry the settlement strength and public trust of central bank money into digital use. That makes it different from ordinary private payment balances. The idea is that people could use a digital form of money backed directly by the public monetary authority. It is one of the clearest signs that the story of money is still evolving. A currency's exchange rate is the price of one money in terms of another money. Just as bread has a price and oil has a price, currencies also have prices when compared with each other. This matters because money is not only used inside borders, it is also constantly being measured against other forms of money around the world. Money works across institutions because one person's asset is often another institution's liability. Your bank balance may feel like your money, and from your point of view, it is. But from the bank's point of view, it is something the bank owes you. This layered structure is one of the quiet truths beneath modern finance. Money works across space by allowing value to travel much farther and more easily than physical goods can. A worker can send earnings across borders. A buyer can pay for an item made far away. A government can raise funds from investors in different places. Money lets value move where objects themselves cannot move so quickly. the same unit of money can serve many roles in a single day. It can arrive as wages, be used to buy food, pay debt, settle taxes, or rest in savings by night. This flexibility is one reason money is so powerful. It is not tied to one purpose. It is a general tool that can flow through many different uses. Money works best when people trust that it will be accepted later in exchange for goods, services, or debt payments. That acceptance is the basic social agreement beneath every transaction. People are willing to work for money today because they believe it will still be useful tomorrow. Trust is the quiet engine that keeps the whole system moving. Economists often describe money by what it does. It works as a medium of exchange, which helps people buy and sell. It works as a unit of account, which lets prices be measured in one common scale. And it works as a store of value, which helps purchasing power move through time. In a barter system, trade depends on what is called a double coincidence of wants. Each person must want exactly what the other person is offering at the same time. That makes exchange slow and limited. Money solves that problem by becoming the shared item everyone is willing to accept. Because money removes the need for direct barter, people can sell first and buy later. That may sound simple, but it changes everything. It allows more specialization, more planning, and more flexible trade. In many ways, money expands the range and rhythm of economic life. As a unit of account, money allows very different things to be priced in the same measuring system. Rent, bread, fuel, wages, and transport can all be compared in one scale. Without that shared measure, economic calculation would become much harder. Money makes comparison and planning far more manageable. As a store of value, money lets purchasing power be carried into the future. A person can earn today, hold that value, and use it later when needed. This does not mean money always keeps its value perfectly. Inflation can weaken that function, but the store of value role is still central to how money works. In modern economies, money is not just paper bills and coins. Most of it exists as balances in bank accounts, recorded electronically. That means everyday money is often ledger-based rather than physical. The numbers on a statement are now more central to economic life than the notes in a pocket. Physical cash is central bank money used by the public, while bank deposits are created within the commercial banking system. Both can function as everyday money, but they are not the same thing. One is issued directly by the Central Monetary Authority, and the other exists as a bank liability that people can spend and transfer. That distinction is quiet, but important. Money is often described as a special kind of IOU because it represents a claim that others widely trust. Many financial relationships are forms of promise, but money is the promise that becomes broadly acceptable. It is a claim people expect others to honor in daily life. That is one reason trust is woven into its nature. A currency keeps working only if people believe others will continue accepting it tomorrow, not just today. Money is therefore deeply tied to expectation. It is not enough for it to work in the present moment. People must also believe in its continued usefulness. Price stability matters because money becomes easier to use when prices do not change wildly from month to month. If values swing too sharply, planning becomes harder for households and businesses alike. Long-term contracts become more stressful, and comparison across time becomes less reliable. Stable prices help money remain a clearer measuring tool. Inflation is the general rise in prices over time, not just the rising price of a single item. One expensive product does not by itself mean inflation is taking place. Inflation describes a broad shift in purchasing power across the economy. It is about the changing value of money relative to many goods and services. When inflation rises, each unit of money buys less than before. The same salary may still show the same number, but that number can stretch less far in daily life. This is why inflation feels so personal. It changes not only prices on shelves, but also how far earnings can go. Mild inflation and runaway inflation are very different situations. What matters most is not simply whether prices move, but whether they remain low and stable enough for people to plan around them. In a stable setting, money can still work smoothly. In an unstable one, confidence begins to weaken. Money is easier to use in long-term contracts when people expect its value to remain relatively predictable. A mortgage, wage agreement, lease, or pension plan all become easier to manage when money is steady. Predictability supports trust, and trust supports the practical use of money over long stretches of time. A society can use many payment instruments at once, including cash, cards, transfers, and digital tools. But all of them depend on systems of trust, record keeping, and settlement. The payment method may change, yet the underlying need for reliable records and shared confidence remains the same. The surface evolves, while the foundation stays familiar. Coins and notes are visible forms of money, but deposits are ledger money recorded in account systems. One can be touched and counted by hand. The other exists through entries in institutional records. Both can be spent, yet they belong to different layers of the monetary world. Digital payments often move information first and settlement later. A person taps a card or presses a button, and messages race through networks linking banks and payment providers. What looks instant from the outside may involve several coordinated steps behind the scenes. Modern payments often feel simple because the complexity is hidden so well. Money works socially as much as mechanically. Shared belief in its usefulness gives it everyday power, while systems and institutions give that belief practical form. Without the social side, the mechanics would feel empty. Without the mechanical side, the social belief would have nowhere dependable to rest. A bank deposit is money from the customer's point of view because it can usually be spent, transferred, or withdrawn. People treat those balances as real spending power in their daily lives. That practical usability is what matters in ordinary experience. If a balance can pay the rent or buy dinner, it functions as money. Deposits are also liabilities of banks, meaning the bank owes that money back to the depositor under the account terms. So the same balance is seen differently, depending on perspective. For the customer, it is an asset. For the bank, it is an obligation. Banks use deposits as a major funding source for loans and investments. Deposit balances are therefore not just passive numbers resting in accounts. They are part of how banks support wider economic activity. The savings and transaction balances held by customers connect directly to the credit system. When a borrower repays the principal on a bank loan, the corresponding bank-created deposit money is reduced. In that sense, repayment can reverse part of the earlier money creation. The loan expanded deposits when it was made, and principal repayment contracts them as it is paid down. Money creation and destruction can both happen inside ordinary banking activity. Interest payments on loans are different from principal repayment. Principal reduces the loan itself, while interest transfers income to the lender as the price of borrowing over time. That difference matters because not all money flowing back to a bank does the same thing. One part changes the outstanding debt, and another part is the cost of using the money. The amount of money banks create depends partly on whether they believe loans will be profitable and repayable. Banks do not simply create money whenever someone asks. They make judgments about risk, return, and the borrower's capacity to pay. Credit creation is therefore shaped by confidence and caution. Banks are constrained by capital rules, liquidity needs, funding costs, and the creditworthiness of borrowers. not just by a simple reserve story. They have to think about safety, regulation, and the possibility of losses. Modern banking is not just about making loans. It is about making loans while staying sound enough to survive. If banks expect a loan to perform badly, they may refuse it, even when the borrower wants the money. This reminds us that money creation through lending is selective, not automatic. The desire to borrow is only one side of the relationship. The lender's willingness to take the risk is just as important. When one bank customer pays another customer at the same bank, the bank can settle the payment internally by adjusting its own records. No outside bank needs to be involved. This is one of the simplest kinds of payment movement. Sometimes money moves not by traveling outward, but by changing positions inside one institution's books. Central banks use monetary policy to help manage the economy, especially by aiming for stable prices and steadier overall conditions. They do not control every price directly, and they do not decide what every business or family will do. Instead, they influence the financial environment around borrowing, lending, saving, and spending. In that way, they help shape the conditions in which money moves through the economy. Price stability is important because money becomes much easier to use when its value does not swing sharply. When prices are fairly stable, families can plan their budgets more calmly, businesses can make longer-term decisions, and contracts become easier to understand. If prices rise or fall too unpredictably, money stops feeling like a steady measuring tool. Stability gives money a kind of quiet reliability. Many central banks set inflation targets because expectations matter almost as much as current conditions. If people believe inflation will stay under control, they often make calmer choices about wages, prices, borrowing, and saving. That belief can help support the goal itself. In other words, money works better when people trust not only the currency, but also the institutions guiding it. Open market operations are one of the main ways central banks influence the financial system. When a central bank buys or sells securities, it changes the amount of reserves in the banking system and helps guide short-term interest rates. These actions may sound distant from ordinary life, but they affect the wider cost of credit. Over time, that can shape how easily money flows through the economy. When a central bank buys securities, it generally adds reserves to the banking system. When it sells them, it usually pulls reserves out. This matters because reserves help banks settle payments and manage short-term liquidity. So even though these operations happen in financial markets, they influence the wider conditions in which money is created, moved, and priced. The short-term goal of these operations is often to guide interest rates in money markets rather than to control lending in a direct and mechanical way. Central banks usually influence the economy by affecting the price of money, not by commanding each bank to lend a specific amount. That approach works through incentives, expectations, and market conditions. It is a quieter form of influence, but often a powerful one. One modern policy tool is interest paid on reserve balances. By paying interest on reserves, a central bank can help put a floor under short-term rates and guide financial conditions more precisely. This may seem technical, but it shows that money is shaped not only by quantity, but also by the returns different forms of money can earn. Even the hidden layers of the system have prices attached to them. The discount window is another important part of the system. It gives banks a way to borrow from the central bank against eligible collateral when they need short-term funding. This does not mean banks use it casually all the time, but it exists as a support channel, helping the payment and banking system remain steady when pressure appears. Reserve requirements have historically been part of monetary policy, but they are only one piece of a much larger framework. Modern central banking relies on many tools working together, including reserve policy, interest rate guidance, liquidity support, and communication. So money is not managed through one single lever. It is shaped through several connected mechanisms. The federal funds rate in the United States is the rate at which certain institutions lend reserve balances to one another overnight. That may sound far removed from ordinary life, but it sits near the center of the financial system. Because reserves help settle payments between banks, the price of borrowing reserves can influence many other interest rates. This is one of the ways central banking reaches into the wider economy. Monetary policy affects borrowing and spending partly by influencing market interest rates more broadly. When short-term rates shift, many other rates across the economy can move as well. Mortgages, business loans, savings returns, and bond yields can all be affected over time. So the policy path of the central bank can quietly shape everyday financial decisions. If borrowing becomes more expensive, some households delay major purchases and some businesses postpone investment plans. A family may wait longer to buy a car or home. A company may slow expansion or reduce new projects. In this way, the cost of money affects the timing of economic activity. If borrowing becomes cheaper, the opposite can happen. Households may feel more comfortable financing large purchases, and businesses may see more projects as worthwhile. Lower borrowing costs do not guarantee a wave of activity, but they can make spending and investment more attractive. Money, in that sense, becomes easier to put to work. Inflation can happen when demand across the economy runs ahead of the economy's ability to produce enough goods and services. Too much pressure chasing limited supply can push prices upward. But this is only one path to inflation. It is a major one, though, because it shows how money, spending, and production are tied together. Inflation can also come from other sources, including supply shocks, exchange rate changes, and shifting expectations. For example, if imported goods suddenly become more expensive, domestic prices can rise even without a boom in local demand. This shows that the value of money is influenced by both domestic and international forces. The story of prices is rarely caused by just one thing. Stable inflation helps money work more smoothly because it makes contracts, wages, pricing, and planning easier to manage. A world with low and predictable inflation is not perfectly still, but it is more readable. People can compare present and future values with less uncertainty. Money becomes a steadier guide when price movement is calm and understood. Deflation, which is a broad fall in prices, can also be disruptive. It may sound pleasant at first because prices are lower, but falling prices can change the burden of debt and encourage people to delay spending. If people expect things to be cheaper later, they may wait. That can create its own kind of slowdown, which is why both rising and falling price instability matter. Central bank credibility matters because expectations about future policy influence what people do now. If businesses believe inflation will stay under control, they may be less likely to raise prices aggressively. If workers expect stability, wage decisions may be calmer as well. The future that people imagine can shape the economy in the present. Economists use different money supply measures because not all forms of money are equally easy to spend. Some forms are very liquid and can be used almost immediately, while others are a little less convenient and more like near money. Narrow measures focus on the most usable kinds. Broader measures include additional deposits and similar claims that are still important, but not quite as immediate. A rise in the quantity of money does not automatically and instantly turn into higher prices in a simple one-step way. What matters too is whether people spend that money, hold it, or move it into other assets. Money demand, confidence, and economic conditions all play a role. So the path from money growth to inflation is real, but it is not mechanical or instant. People hold money for several reasons. They need it for daily transactions, They keep some for safety in case of surprise expenses, and they value the convenience of having liquid funds available. Money is not only idle wealth sitting still. Very often, it is held because it gives people flexibility, timing control, and peace of mind. When interest rates rise, holding money that earns little or no interest becomes less attractive compared with assets that do pay a return. This can influence how much cash or deposit money people choose to keep close at hand. So the demand for money is partly shaped by what people must give up by holding it. Convenience is valuable, but so is return. Monetary policy moves through the economy in many channels at once. It affects financial markets, bank lending conditions, exchange rates, asset prices, and the expectations of households and firms. That means money is never shaped by one single path alone. The system is layered, and policy travels through several layers together. Central banks can create reserve money, but they cannot force people to borrow, spend, or invest on a schedule. This is an important limit. Policy can change conditions, but it cannot directly command confidence or private decisions. Money may be public in its framework, yet its motion still depends on millions of choices made by others. Money works at the national level partly because central banks help defend confidence in both the currency and the payment system. They are not the whole story, but they stand at a critical point where settlement, liquidity, and public trust meet. If confidence in those institutions weakens badly, money itself becomes harder to use smoothly. That is why their role is so foundational. Central bank liquidity tools matter most when the financial system needs temporary support to keep payments and credit flowing. During stress, the problem is not always that assets have no value. Sometimes the problem is that institutions need time and liquidity to keep operating smoothly. In such moments, money depends not only on wealth, but on timing and confidence. Monetary policy is powerful, but it does not replace taxation, government spending, productivity growth, or the legal system. Money does not operate in isolation. It depends on the broader structure of the economy and the state. Central banks influence important conditions, but they do not single-handedly create prosperity. Payment systems are the networks and rules that move money claims from one person or institution to another. When someone pays rent, buys groceries, or sends money across town, those systems help make the transfer real. Without them, account balances would remain trapped in place. Payment systems are the pathways that let money travel. Many everyday card payments do not move cash at the moment of purchase. Instead, they trigger electronic messages that later settle between institutions. This is why a simple tap at a terminal can involve authorization, communication, record keeping, and later settlement. The visible action takes a second. The invisible coordination takes a bit more. Checks are older technology, but they still depend on organized clearing and return processes between banks. A check is not just a handwritten note. It enters a formal system where institutions verify, route, and settle the payment. Even older forms of money movement rely on carefully designed infrastructure. Debit cards and credit cards may look similar in the hand, but they work in different ways. A debit card usually pulls money from a deposit account that already exists. A credit card, by contrast, creates a short-term loan from the card issuer. So one spends existing account money, while the other borrows first and settles later. Electronic transfers can move money without paper changing hands, but they still rely on rules, account records, and institutional coordination. Nothing physical may pass between the people involved, yet a transfer is still a legal and financial event. Digital movement does not remove structure. It simply hides more of it from sight. An unauthorized transaction is not just a technical glitch. It can trigger formal consumer protection procedures, investigation timelines, and responsibilities for the financial institution. This shows that money is protected not only by technology, but also by law. When something goes wrong, rules step in to help decide what must happen next. Reporting a lost or stolen access device can activate formal error resolution duties for the institution involved. In other words, the act of telling the bank or provider quickly can change how the situation is handled. Timing matters in consumer protection, just as it does in payments. Money systems are deeply tied to process. Central bank money is especially valued in wholesale settlement because it carries no private bank credit risk at the moment of final payment. When banks settle with central bank money, they are using the safest common asset in the system. That safety helps support trust between institutions. And that trust, in turn, helps support the wider public use of money. Fast retail payment systems aim to make ordinary transfers much quicker, but speed alone is not enough. The back-end design still has to be resilient, reliable, and secure. A payment that is fast but fragile would not serve the public well. So modern money tries to combine convenience with strength behind the scenes. Payment systems matter for government finance too, because central banks often act as banker for the government as well as for banks. Public money flows through many of the same channels that support private payments. Taxes, benefits, debt operations, and government transfers all depend on financial plumbing. So the monetary system supports both state activity and ordinary daily life. Cash remains useful because it settles instantly between two people without requiring the payer's bank to be online in that moment. It can work hand-to-hand, directly, without network approval. That makes cash different from purely digital forms of payment. Its simplicity is part of its enduring strength. Digital payments depend on communications networks, identity checks, fraud controls, and settlement between institutions. What seems effortless on the front end is supported by many layers on the back end. The movement of digital money is really the movement of verified instructions through trusted systems. The simplicity people experience is built on hidden complexity. Prepaid accounts store value in advance, which makes them different from normal deposit accounts or credit cards. The money is generally loaded first and then spent later. This changes how the product behaves and how consumers use it. It sits in its own place between ordinary banking and ordinary credit. Some prepaid products also include or connect to credit features, and that can change their legal treatment. Once borrowing enters the picture, the rules and risks can shift. This is a reminder that financial products often blur together at the edges. The categories matter because law, fees, and consumer protections can depend on them. Non-sufficient funds fees and overdraft fees come from different situations, even though people often experience both as payment trouble. An NSF fee may be charged when the institution declines a transaction because there is not enough money. An overdraft fee usually relates to a transaction that is allowed to go through despite insufficient funds. The difference is quiet, but real. Timing matters in money management because income and bills often do not arrive on the same day. A person can be fine over the month as a whole and still run into a short-term problem on one difficult date. This is why cash flow and total income are not exactly the same thing. The calendar itself can shape how money feels. A payment can fail even when someone is solvent overall if the money is simply not in the right place at the right time. This is one of the quiet truths of household finance. Money is not only about how much exists in total. It is also about when it arrives and where it is held. Payment convenience is one reason people hold deposits even when other assets might offer better returns. A bank balance may not always earn the highest income, but it can be used quickly for ordinary spending. That usefulness has value of its own. Sometimes people accept lower returns in exchange for ease, speed, and flexibility. Credit is the ability to borrow money, while debt is money that has already been borrowed and is still owed. The difference is simple but important. Credit is potential access to purchasing power. Debt is an existing obligation created by using that access. A loan allows spending to happen before income is fully in hand. This can help households and businesses move forward sooner than they otherwise could. It can support education, housing, transport, investment, and expansion. Credit, in that sense, is one of the ways money bridges the gap between present needs and future income. Secured debt is backed by an asset that can be claimed if the borrower does not repay. That asset gives the lender extra protection, which is one reason secured loans often have different pricing from unsecured loans. The collateral changes the risk, and when risk changes, the cost of money often changes with it. Unsecured debt is not tied to a specific pledged asset, so the lender has less direct protection if the borrower defaults. Because of that, unsecured borrowing often carries higher interest rates. The price reflects the added uncertainty. Money is often cheaper when the lender has stronger backup claims. A mortgage is a classic example of secured borrowing because the home itself is part of the contract structure. Auto loans work similarly, with the vehicle serving as collateral. Credit card debt, by contrast, is usually unsecured, which helps explain why its interest rates can be much higher. These differences show how the structure of a loan shapes the price of borrowing. Interest is the price of borrowing money over time, but the stated interest rate does not always tell the full story. Compounding and fees can change the true cost quite a lot. Compound interest means interest is added to principal, and later, interest is charged on that larger amount. Over time, that can make borrowed money much more expensive, or saved money much more powerful. The longer compound interest continues, the more of the growth comes from earlier accumulated interest, rather than from the original deposit alone. In the beginning, most of the increase comes from the money first put in. But as time passes, the interest begins earning interest on itself, and that changes the shape of growth. This is one of the quiet reasons time can matter so much in money. A grace period on a credit card is the stretch of time between the end of a billing cycle and the payment due date, when new purchases may avoid interest if the balance is paid in full. This means the card can sometimes act like a short-term tool of convenience rather than an expensive loan. But that benefit depends on the account terms and on paying on time. The calendar matters just as much as the spending. Credit card companies are not required to offer a grace period on every kind of balance, even though many do for ordinary purchases. Some balances, such as certain cash advances or carried over amounts, may begin costing interest much sooner. This is why two charges on the same card can behave differently. The details of the account agreement shape how the money really works. Paying the full balance by the due date is usually what protects the interest-free benefit of a grace period on purchases. If the full amount is not paid, interest may begin building on part or all of the balance, depending on the rules. A credit card can therefore feel cheap one month and costly the next. The difference often comes down to whether the entire balance was cleared in time. Minimum payments make credit cards flexible because they allow a person to avoid immediate default even when money is tight. But that same flexibility can quietly stretch repayment over a very long period if the remaining balance stays large. Small payments can make the present feel easier while making the future more expensive. So convenience and cost can sit very close together. A late payment can trigger a late fee, and it may also raise the total borrowing cost through extra finance charges. Missing a due date does not only add one penalty. It can cause the balance to stay around longer and grow more expensive over time. That is why payment timing is such an important part of how borrowed money behaves. The real economic effect of borrowing depends heavily on what the money is used for, not merely on the existence of the debt itself. Borrowing for a tool, education, or productive asset can work very differently from borrowing for short-lived consumption. Debt is not all one thing. Its long-term effect depends on what it helps create, protect, or consume. Borrowing to buy an asset that produces income works differently from borrowing for immediate consumption. If the asset helps bring in money later, the debt may support future repayment more directly. If the borrowed money is used only for something that disappears quickly, repayment depends more fully on later income from elsewhere. So the same loan amount can have very different consequences. Lenders price risk partly by estimating how likely a borrower is to repay on time. They are trying to judge uncertainty, not only record a number. The interest rate often reflects that judgment. In this way, the price of money changes depending on how safe or risky the lender believes the relationship will be. Credit reports matter because lenders, landlords, insurers, and some service providers may use them when making decisions. These reports are not just for banks deciding on loans. They can influence access to housing, services, and other forms of financial opportunity. A credit record becomes a kind of financial history others may consult. A credit score is built from information in a credit report rather than from a lender's personal opinion alone. It is a structured summary based on patterns in reported borrowing behavior. That means the score is tied to data, not to a private guess. Even so, the score is still only a model, not a complete picture of a person's life. Payment history can influence a credit score because late or missed payments suggest a higher repayment risk. A lender looking at the record may see those delays as signs of future difficulty. This is why regular on-time payment behavior matters so much in credit systems. Reliability over time becomes part of the numeric picture. The amount of money owed can also influence a credit score because heavy borrowing may imply greater strain on the borrower. Large balances can suggest that future payments may become harder to manage. The system is not only asking whether someone has borrowed, it is also looking at how much obligation is already being carried. The length of time accounts have existed can affect a credit score because longer histories provide more information about how someone handles debt over time. A long record gives lenders more data about consistency and repayment patterns. A short record may not be bad, but it offers less to study. Time, once again, becomes part of how money is judged. Opening many new accounts in a short period can affect a credit score because it may suggest changing risk. A sudden burst of new borrowing can look different from steady long-term use. The scoring system may read that pattern as a sign to be cautious. So not only balances, but also borrowing tempo can matter. Different types of credit accounts can matter because scoring systems often look at the mix of borrowing relationships. A person using only one kind of credit may appear differently from someone with a broader and well-managed mix. This does not mean more debt is automatically better. It means the pattern and type of borrowing also help shape the credit picture. Reviewing a credit report is partly about checking for identity mistakes, unfamiliar accounts, and inaccurate balances. A report is not useful only because others read it. It is also important because the person named in it can inspect it for problems. Quiet errors in financial records can have very real consequences if they are never noticed. People can dispute information they believe is incorrect on a credit report, rather than simply accepting the record as final. That matters because financial data systems are powerful, but they are not beyond correction. The right to challenge mistakes helps make the system fairer. Money works better when records can be checked and repaired. A free official channel for credit reports exists because lawmakers treated access to personal credit records as a consumer right. That means people are not supposed to be shut out from seeing the financial information used to judge them. Access supports accuracy, fairness, and self-protection. A person can only manage what they are able to see. Credit is not automatically harmful. The trouble begins when the future income needed to repay becomes too uncertain or too small to carry the obligation comfortably. Debt becomes dangerous not just because it exists, but because repayment may no longer fit the borrower's real future situation. The balance between obligation and future capacity is what matters most. Saving means choosing not to spend all current income, which creates room for future spending or protection against surprise events. It is a way of moving purchasing power forward in time. Even a modest saving habit changes how money feels, because it creates options. Money not spent today can become safety, flexibility, or opportunity later. An emergency fund is cash set aside specifically for unplanned expenses or financial emergencies. It is different from money meant for entertainment, travel, or ordinary bills. Its purpose is to stand quietly in the background until something goes wrong. That special role makes it one of the most practical forms of financial protection. Car repairs, medical bills, home repairs, and job loss are all common reasons emergency savings become important. These are the kinds of events that arrive without much warning and often demand quick payment. Because life can shift suddenly, money that is reserved for surprise costs becomes deeply valuable. The calmest money is often the money prepared in advance. Emergency savings reduce the need to borrow at the exact moment a household is already under stress. Without savings, a problem can quickly turn into a debt problem as well. With savings, the same event may still be unpleasant, but it does not have to create immediate financial dependence on expensive credit. Saved money can soften the impact of bad timing. Households with no savings are more likely to show other forms of financial fragility, including weaker credit outcomes. This is not only because they have less money, it is also because they have less room to absorb shocks. A missing cushion can make every surprise feel sharper and every mistake more costly. Even small savings can improve flexibility because cash reserves buy time as well as purchasing power. A small amount may not solve every problem, but it can delay a crisis, prevent a fee, or reduce the need for costly borrowing. In money matters, time itself can be a valuable resource. Savings often provide that time. Saving and investing are related, but they are not the same. Savings usually prioritize safety and easy access, while investing usually accepts more uncertainty in exchange for the chance of higher returns. One protects short-term flexibility more directly. The other aims more toward long-term growth, even though the value can move up and down. A savings account is usually designed for safety and access, rather than for maximizing long-term growth. Its job is to keep money available and relatively stable. That makes it useful for short-term needs and emergency funds. But because it emphasizes safety and liquidity, it may not grow as quickly as riskier investments over long periods. Investing moves money into assets such as stocks, bonds, or funds that can rise or fall in value. This means investing introduces uncertainty in exchange for possible growth. The money is no longer sitting still in a stable account. It is now connected to markets, business performance, interest rates, or other changing conditions. Return is what an asset earns, while risk is the uncertainty surrounding that outcome. A return tells you what happened or what may be possible. Risk reminds you that the path is not guaranteed. In finance, those two ideas are always connected. Stocks represent ownership shares in a company. When someone buys stock, they are not lending money in the same way as with a bond. They are buying a piece of ownership, however small. That means their fortunes become more tied to the company's success, struggles, and market value. Investors may buy stocks for several reasons, including the hope of price appreciation, dividend payments, or voting power. Some want growth if the company becomes more valuable. Some want income from dividends. Others care about ownership rights that come with holding shares. Companies issue stock to raise money for expansion, operations, or other business needs. Instead of borrowing through debt, a company can bring in funds by selling ownership stakes. This gives the company capital without promising fixed debt payments in the same way a bond would. But it also means sharing future upside and ownership with investors. Bond investors are lenders, not owners, because a bond is a debt obligation. When someone buys a bond, they are effectively providing money to the issuer under agreed terms. The relationship is built around repayment and interest, not ownership rights. This is one of the key differences between debt and equity. A corporate bond is essentially an IOU from the issuing company to the investor. It says, in effect, that the company has borrowed money and promises to repay it under specified conditions. That makes bonds feel quieter than stocks in some ways, but they are still part of the broader movement of money through firms and markets. The company uses money now and commits to obligations later. Bond contracts generally specify interest payments and a maturity date when principal is due back. This makes bonds more structured than many other financial claims. The investor knows the basic timetable the contract is supposed to follow. That clear schedule is one reason bonds often feel more predictable than ownership shares. Stocks usually expose investors to more upside and downside tied to company fortunes than plain bonds do. If the business grows strongly, stockholders may benefit more. If it struggles badly, stock prices may fall sharply. Stock ownership is therefore often more sensitive to the changing story of the company. A mutual fund pools money from many investors into one portfolio. Instead of each person buying every security separately, many people place funds together and hold them through a shared structure. This makes it easier to access a diversified group of investments. The fund becomes a container holding many financial pieces at once. A fund can earn dividends from stocks and interest from bonds it owns. So the income received by the fund depends on the kinds of assets inside it. A fund is not a source of return by itself. It is a structure that gathers returns from the securities it holds. Mutual funds can also pass through capital gains when they sell holdings that rose in price after accounting for losses. This means investors may receive value not only from ongoing income, but also from changes in asset prices inside the fund. The fund is therefore a moving financial environment, not just a static basket. What happens inside it can shape what investors ultimately receive. An ETF is also a pooled investment vehicle, but it is generally traded on an exchange like a stock. That means investors usually buy and sell it during market hours through exchange trading rather than through the older mutual fund process. It still gathers money into a shared portfolio, but the way it is accessed can feel more like stock trading. The wrapper changes, even though the idea of pooling remains. Fund fees matter because costs reduce the part of the return that investors actually keep. A portfolio may perform reasonably well, but the investor's net result can still be smaller after fees are removed. This is one of the quiet truths of finance. What money earns is important, but so is what gets taken away along the path. Diversification means spreading money across many holdings, so that one poor outcome matters less to the whole portfolio. It does not eliminate risk completely, but it can reduce the damage caused by one company, one bond, or one sector performing badly. This is one of the most basic ways investors manage uncertainty. Instead of depending on one point of success, they spread exposure across many points. Pooled funds make diversification easier for small investors because one purchase can represent many securities at once. Without pooling, Building a wide portfolio could require much more money and effort. A fund can turn one decision into exposure across many holdings. That convenience is one reason pooled investing has become so common. Marketable securities can usually be bought and sold before maturity, which is why their prices change with market conditions. The value is not fixed simply because a contract exists. It responds to new information, changing rates, and investor demand. So a security can have one value when first issued and a different value later in the market. A higher expected return usually comes with greater risk, greater uncertainty, or lower liquidity. In finance, bigger reward does not usually appear without some trade-off. The extra potential gain tends to be linked to some extra difficulty or danger. That is one reason comparing financial products always involves more than looking at the highest number. Inflation matters to savers because a positive account balance can still lose real purchasing power if prices rise faster than the money grows. The number in the account may go up and still buy less in the outside world. That is why money growth and real improvement are not always the same. The true question is not only how much money there is, but what it can still do. That is why nominal growth and real growth are different ideas. Nominal growth is what the money amount itself does. Real growth asks what happens after rising prices are taken into account. This difference is one of the most important quiet adjustments in understanding money. Inflation-protected securities are designed to address that gap by adjusting value with inflation measures. Their purpose is to help preserve purchasing power more directly than ordinary fixed-value instruments. They are built around the idea that money should not only grow on paper, but also stay meaningful in real terms. In that sense, they try to protect money from the slow erosion of rising prices. Series 1 savings bonds combine a fixed rate with an inflation rate that resets every 6 months. This gives them a split design, with one part that stays steady for that bond and another part that moves with inflation conditions. They are built for people who want a savings product, linked partly to changing prices. The bond quietly reflects both stability and adjustment. The fixed rate on an I bond stays the same for that particular bond, while the inflation component changes over time. That means one part of the return is locked in, and another part adapts to the inflation environment. It is a layered design rather than a single, simple rate. The bond behavior changes as prices change. I bonds can become more appealing when people want a government-backed savings product that is tied partly to inflation. They may feel especially attractive when people are worried about rising prices reducing the value of ordinary savings. This is not because they solve every problem, but because they are built for a very specific concern. They are one example of money being designed to defend itself against inflation. Treasury inflation-protected securities and I bonds both adjust for inflation, but they are structured and traded differently. They are related in purpose, yet not identical in form. One may fit different goals, time horizons, or preferences than the other. This is another reminder that even products created to solve similar problems can work in very different ways. EE&I savings bonds both earn interest monthly and compounded semi-annually. This means interest is tracked continuously through the months, but the compounding step that adds prior earned interest into the base happens every 6 months. The timing of that structure affects how the value grows. Even small technical details like compounding rhythm matter in how money behaves over time. Semi-annual compounding means a bond's base value is recalculated every 6 months to include the interest earned up to that point. After that, future interest is built on the larger amount. It is a simple idea, but over long periods, it can change outcomes meaningfully. The quiet mathematics of compounding can reshape growth far more than many people expect. Saving in bonds is different from saving in deposits because bonds are securities, and that changes how they behave. A deposit is usually built for safety and ready access, while a bond is an investment contract with its own term, price behavior, and market conditions. Even when both are used for saving, they are not doing the same job in the same way. One is mainly about stored money in an account, and the other is about owning a financial instrument with specific rules. Money can sit in cash, deposits, or investments, but each place changes the balance between safety, access, and return. Cash is easy to use, but usually earns nothing. Deposits may be safer and more practical than many investments, but often do not grow quickly. Investments may offer more growth, yet they ask for more patience and acceptance of risk. Financial planning is largely the art of deciding how much money should stay liquid, how much should be protected, and how much can be exposed to risk. This is not only about chasing the highest return. It is also about matching money to real-life needs, such as bills, emergencies, and future goals. Good planning means placing money where it fits its purpose best. Time horizon matters because money needed next week should usually be handled very differently from money meant for decades ahead. Short-term money often needs stability and quick access. Long-term money can sometimes accept more movement and uncertainty because there is more time to recover from market changes. The future distance of a goal changes what kind of home that money needs. Real wealth building depends on more than income alone. Saving rate, investment return, inflation, and the avoidance of expensive mistakes all shape the final outcome. A high income can be weakened by poor habits, while moderate income can quietly grow through steady choices. Money builds over time through behavior, as much as through earnings. Government bonds are often used as reference points in finance because they are large, standardized, and widely traded. Their yields become important benchmarks for pricing many other forms of borrowing and investing. When people talk about interest rates in a broad financial sense, government bond markets are often part of that conversation. They help set the background tone for the wider money system. Bond maturity matters because the timing of repayment affects both risk and sensitivity to interest rate changes. A bond that matures soon behaves differently from one that stretches far into the future. The longer the wait for repayment, the more time there is for rates and conditions to shift. Time changes not just when money returns, but how stable the bond's price can be in the meantime. The price of an existing bond and the market interest rate tend to move in opposite directions. When market rates rise, older bonds paying lower rates become less attractive, so their prices usually fall. When market rates fall, older bonds paying relatively more can become more valuable. This quiet opposite movement is one of the key ideas in understanding bond markets. If new bonds start paying more, older lower-rate bonds usually become less attractive unless their price drops. That price adjustment is what helps bring old bonds back into line with current market conditions. A bond is not only a fixed promise held in isolation, it is also an asset that competes with newly issued alternatives. Dividend payments are not guaranteed in the same way bond coupon payments are contractually structured. A company may choose to reduce or stop dividends, while bond payments are part of a debt obligation. This is one reason stock income and bond income feel different, even when both can produce cash flow. Ownership income is generally less fixed than lending income. Shareholders are owners, so their returns depend heavily on business performance and market valuation. If the company grows, earns more, or becomes more admired by investors, shareholders may benefit. If the company weakens or the market loses confidence, their position may suffer. Ownership carries both possibility and exposure. Bondholders are creditors, so their claims come from debt contracts rather than ownership rights. They are generally promised repayment terms and interest according to the bond agreement. That makes their role different from the role of shareholders, whose returns are tied more directly to the company's changing fortunes. One is lending money, while the other is owning part of the business. A fund wrapper changes how money is pooled and administered, but the underlying return still comes from the securities inside. The fund itself is a structure, not the true source of growth. What really matters underneath are the stocks, bonds, or other assets being held. The wrapper organizes access, but the inner holdings generate the results. Capital gains arise when an asset is sold for more than its purchase price. That increase becomes real only when the sale happens and the difference is locked in. Until then, a gain may exist only on paper as a market value. This is why the timing of selling can matter just as much as the timing of buying. Capital losses can offset some gains inside funds before distributions are calculated. This matters because not every rising investment leads straight to a full taxable or distributable gain. Losses in one part of a portfolio can affect the overall result. Money inside a fund is often shaped by the interaction between winners and losers together. Market volatility is the visible reminder that financial assets are priced continuously as expectations change. Prices move not only because something physical changed overnight, but because people's views about the future shifted. New information, fear, hope, and changing rates all affect what investors are willing to pay. Markets are always reacting to the future they imagine. Liquidity in an investment means it can be turned into spendable money without too much delay or loss in value. A highly liquid asset can usually be sold more easily and converted into usable funds quickly. A less liquid asset may take more time, effort, or price sacrifice. Liquidity is therefore one of the quiet features that changes how useful money feels in practice. Highly liquid money is convenient, but it often earns less than less liquid investments. This is one of the basic trade-offs in personal finance. The easier money is to reach and spend, the less it often grows. The more growth people seek, the more likely they may need to accept delay, fluctuation, or access limits. When people casually say something is risk-free, they usually mean low default risk, not a total absence of all risk. Even a very safe asset can still lose purchasing power to inflation or carry an opportunity cost if better returns are available elsewhere. So safety in money is rarely absolute. It usually means safer in one dimension, not perfectly safe in every dimension. Real returns are what remain after inflation is taken into account. This means the true question is not only how much an investment grew in numbers, but how much more it can actually buy afterward. A return that looks solid on paper may feel smaller in real life if prices rose quickly. Real return is the more practical measure of increased purchasing power. Nominal returns can look healthy, while real returns remain weak if prices are rising quickly. A person might see their money balance increase and still find that everyday life has not become much easier. This gap between appearance and purchasing power is one of the most important ideas in understanding money. Numbers alone do not tell the full story. A portfolio is simply a collection of financial assets held together. It may include cash, bonds, stocks, funds, or other instruments. The idea is straightforward, but the mix inside the portfolio says a great deal about a person's goals, risk tolerance, and time horizon. A portfolio is really a picture of how money has been arranged. Asset allocation is the choice of how much money goes into categories such as cash, bonds, and stocks. This decision often matters more than any single investment pick because it shapes the portfolio's overall behavior. Different allocations create different balances of safety, growth, and volatility. In a quiet way, allocation is one of the deepest choices in money management. Reinvestment is powerful because income payments can themselves start earning returns over time. Interest, dividends, or other payouts do not have to remain idle after they arrive. If they are put back to work, they can begin generating new growth of their own. That is one reason small recurring gains can become meaningful over long stretches of time. Fees, taxes, inflation, and behavior all affect how much of gross return actually becomes lasting wealth. A strong investment result can be quietly reduced by costs and poor timing decisions. This is why building wealth is not only about choosing something that rises. It is also about protecting the gains from erosion along the way. Taxes are one of the main ways governments collect money to fund public services and public obligations. Roads, administration, schools, social programs, and other state functions depend on organized revenue. Taxation is one of the major channels through which money moves from private hands into public use. It is a central part of how modern states operate. A progressive tax bracket system means higher tax rates apply only to higher layers of income, not automatically to every dollar earned. This structure is often misunderstood because people sometimes imagine that entering a higher bracket changes the tax rate on all income at once. In reality, the higher rate generally applies only to the income above the threshold. That layered design is what makes the system progressive. Moving into a higher tax bracket does not mean all income is suddenly taxed at that higher rate. Only the portion within that bracket is treated at the new level. This is why earning more does not usually leave someone with less take-home pay overall, simply because a threshold was crossed. The brackets stack on top of one another rather than replacing the full structure below them. Withholding is the system that takes part of earnings during the year to prepay expected tax liability. Instead of waiting for one large bill at the end, part of the money is held back from paychecks as income is earned. This makes tax payment more gradual and more automatic. It is one example of how money systems often work quietly in the background. A tax refund usually means more money was withheld or prepaid during the year than the final tax bill required. It is not free, new money being created at filing time. It is usually money returning because too much was paid in advance. That is why a refund often reflects timing and estimation, not a special bonus. Owing tax at filing time usually means withholding, and estimated payments were lower than the final amount due. In that case, more of the income was kept during the year, but the balance still has to be settled later. This is the mirror image of a refund. In both cases, the true issue is how closely the payments made during the year matched the real tax obligation. Payroll systems make money work automatically by splitting gross pay into taxes, contributions, and net take-home pay. This means the amount a worker earns is not always the same as the amount that arrives in the account. The payroll process quietly sorts money into different destinations before the worker receives the remainder. It is an example of how money often moves through rules before it feels personal. Government payment systems also depend on banking rails, because benefits, tax refunds, and many transfers are often deposited electronically. Public finance is not separate from payment infrastructure. It relies on many of the same channels used for wages, bills, and private transfers. The state, too, depends on the plumbing of money. Fiscal policy moves money through the economy differently from monetary policy because it works through government taxation and spending. Monetary policy changes financial conditions and the price of money more indirectly. Fiscal policy, by contrast, changes who receives money, who pays money, and how public funds are used. They are two different ways public institutions shape economic life. Public debt instruments allow governments to borrow now and repay over time, rather than matching every bit of spending to taxes in the same moment. This gives states flexibility in how they manage large and ongoing obligations. Borrowing can help spread the cost of spending across time instead of concentrating it all at once. Government finance, like household finance, often involves balancing present needs with future payments. A currency's exchange rate is the price of one money in terms of another money. This means currencies are not only tools of payment. They are also constantly being compared and valued against each other in markets. That price affects trade, investment, travel, and the international meaning of domestic money. Exchange rates matter because they influence the local currency cost of imports and the foreign currency price of exports. If the exchange rate changes, the same goods can become more or less affordable across borders, even when their original prices stay the same. That is why the value of money in foreign terms has real effects on daily economic life. International prices are translated through currency values. A weaker domestic currency can make imported goods more expensive in local money. People may then feel the change through food, fuel, electronics, or other items purchased from abroad. So exchange rates are not only abstract financial numbers, they can shape what ordinary goods cost in everyday life. Exchange rate movements can feed into domestic inflation, especially when imported goods are important in the economy. If foreign items become costlier in local currency, that price pressure can spread more widely. This is one reason inflation is not only a local story. The outside value of money can influence the inside price level. The balance of payments is the accounting framework for a country's transactions with the rest of the world. It records how money, trade, income, and financial claims move across borders. In a broad sense, it is the country-level ledger of international economic interaction. It helps show how domestic money is connected to the wider world. The current account records trade in goods and services, income flows, and certain transfers with the rest of the world. It helps show whether a country is buying more from abroad than it is selling, or vice versa, while also including other cross-border flows. This makes it one of the main windows into a country's external economic position. It is a money story told through trade and income. The financial account tracks how money moves through cross-border investment and financing claims. It includes the ways countries lend, borrow, invest, and hold assets with one another. While the current account captures one side of international interaction, the financial account helps show how those positions are financed. Money crossing borders is often tied to both trade and capital flows together. A country can run a current account deficit and still function normally if capital inflows finance it. This means the country may be spending more abroad than it earns through current transactions, while foreign money continues to flow in through investment or lending. A deficit by itself does not automatically mean crisis. What matters is how it is financed and whether that financing remains stable. External deficits become risky when financing dries up, debt burdens rise too far, or exchange rates move sharply. A situation that is manageable under calm conditions can become fragile when confidence weakens. This is another reminder that money systems depend not only on numbers, but also on trust and continuity. Stability often lasts until financing relationships begin to break. Remittances are money transfers sent by people, often workers abroad, to family members or others in another country. These payments are personal, but they also matter at a larger economic level. They connect households across borders and turn migration into a steady financial link. In many places, remittances are part of everyday survival and planning. Remittances can support household consumption, education, and resilience in the economies that receive them. The money may help pay for food, rent, school costs, or medical needs. Because of that, remittances often act as stabilizing income for families. A transfer from one worker far away can become practical support for many people at home. Digital payment systems have made some remittance corridors faster and more accessible than older cash-based channels. Sending money no longer always requires the same physical steps it once did. Digital tools can reduce time, travel, and sometimes cost. In that way, the movement of money across distance has become more flexible for many people. Cross-border payments are often slower and more expensive than domestic payments because more institutions and legal systems are involved. A local transfer may move through a familiar and unified framework, while an international one may pass through several layers. Each extra layer can add cost, delay, and complexity. Sending money across borders is often much harder than sending it across town. Differences in anti-money laundering rules, legal frameworks, and settlement systems can complicate international transfers. These safeguards and institutional differences are important, but they also add friction. The movement of money across countries is not simply a technical switch. It is shaped by rules, compliance, identity checks, and coordination between very different systems. Remittance disclosures are important because senders need to know the exchange rate, the fees, and the expected amount the recipient will actually receive. Without that clarity, the true cost of the transfer can be hard to judge. Good disclosure helps people compare options and understand what is happening to their money. In money matters, transparency often protects trust. Remittance providers must also disclose error resolution and cancellation information to consumers in covered situations. That matters because sending money is not only about speed and price. People also need to know what happens if something goes wrong, whether a transfer can be stopped, and what protections exist if the amount or destination is wrong. Clear rules make money movement feel safer and more understandable. Mobile money can expand financial inclusion by letting people send, store, and receive value through phones, rather than relying only on physical bank branches. This can be especially important in places where traditional banking access is limited or inconvenient. A mobile phone can become a gateway to payments, savings, and transfers that might otherwise be difficult to reach. In that sense, money becomes more accessible when financial tools fit ordinary daily technology. In places where mobile money is widespread, digital payment use tends to be higher. Once people become comfortable using phones to move and store value, other digital financial habits often grow around that experience. The payment culture itself can begin to change. Money starts to travel through everyday devices rather than through longer physical routines. Digital account ownership and actual usage are not the same thing. A person may have an account and still not use it actively for saving, borrowing, or making payments. This is why account numbers alone do not tell the full story of financial inclusion. Real inclusion means the account becomes useful in ordinary life, not just officially open. Financial inclusion is about safe, affordable, and convenient access to useful financial services, not just about opening more accounts. If the service is too costly, too hard to trust, or too impractical to use, access on paper may not help very much. Money works best when people can use the system with confidence and regularity. Inclusion is therefore about usefulness, not just availability. Global account ownership has risen over time, showing that more adults are entering formal financial systems. This reflects a broad shift toward greater participation in banking and digital finance. But the presence of more accounts also raises deeper questions about usage, trust, and long-term benefit. More entry into the system is important, yet it is only one step in the larger story. Even with that progress, gender gaps and other access gaps remain part of the global financial landscape. Not everyone enters the money system equally or uses it with the same freedom. Social, legal, technological, and geographic barriers can all shape access. So the spread of money tools is still uneven across populations. Governments can promote inclusion by paying wages or transfers into accounts because that gives people a practical reason to enter the formal financial system. Once money begins arriving there regularly, the account can become more useful for saving, paying bills, or making purchases. Public payments can therefore act as a bridge into wider financial participation. The first step into formal finance is often tied to a real need. Utility bill payments and merchant payments can also draw people from simple account ownership into more active financial use. Once an account is used for repeated practical tasks, it becomes part of everyday life rather than just a formal record. Money systems become stronger when they are woven into normal habits. Repetition turns access into usefulness. Financial inclusion is strongest when accounts are not only available, but also trusted, low-cost, and practical in daily life. A financial service may technically exist and still remain unused if it feels confusing, expensive, or risky. People need real reason and real comfort to bring money into the system. The human experience around money matters as much as the technical product. Correspondent banking has long been part of cross-border payments, but long chains of institutions can add cost, delay, and complexity. When money passes through many hands before reaching its destination, each step can introduce friction. That is one reason international transfers often feel heavier than domestic ones. The path matters, not just the amount being sent. Payment hubs and newer digital players aim to shorten those chains and improve efficiency in some payment corridors. Their goal is often to make transfers faster, clearer, and sometimes cheaper by simplifying the route money takes. This is part of a larger effort to modernize how money travels across borders. Even in global finance, shorter paths can make a big difference. The international movement of money is not only a technical matter. It is shaped by regulation, identity checks, currency conversion, and final settlement arrangements all at once. That means moving money internationally requires more than pressing a button. It depends on law, trust, compliance, and coordinated infrastructure across borders. A country's money is deeply connected to its external position because trade, borrowing, and exchange rates all interact with one another. Domestic money may feel local, but its strength and meaning are partly influenced by the outside world. Imports, exports, foreign investment, and currency movements all feed back into the home economy. National money is never fully isolated. Domestic money can feel simple inside a country while becoming much more complex the moment it crosses borders. At home, people often experience money through familiar rules, institutions, and prices. Internationally, that same money meets different laws, settlement systems, and exchange relationships. The border reveals how layered money really is. Deposit insurance exists to protect eligible deposits if an insured bank fails. This protection matters because everyday money would feel far less stable if people constantly feared losing ordinary balances due to a bank-specific collapse. Deposit insurance helps support confidence in deposits as usable money. It turns a fragile private claim into something that feels much steadier to the public. In the United States, insured deposits are automatically protected to at least $250,000 per depositor, per insured bank, per ownership category. That structure means coverage is not just one total number applied in every possible way. The details of ownership and institution matter. Money protection follows legal categories as well as balances. Deposit insurance is important because it helps people treat bank deposits as everyday money without having to constantly judge the health of each bank. Most people do not want to act like bank analysts just to use a checking account. Insurance helps remove that burden. It allows ordinary money use to remain calm and routine. If a bank fails, insured depositors are typically given access to insured funds quickly, often by the next business day. Speed matters here because money is not useful if protection exists only in theory but arrives too late for daily life. Fast access helps prevent panic and disruption. The point of protected money is that it should remain practically usable. Deposit insurance coverage depends on account ownership category, not simply on the total balance across every arrangement. That means the legal structure of accounts can shape how much protection applies. Two people with the same total amount may not have the same insurance result if their accounts are organized differently. The design of the account matters, not just the number inside it. Borrowers still owe their loans even if the bank that made them later fails. The bank's condition and the borrower's obligation are not erased together. A failure may change who manages the loan or receives the payments, but it does not normally remove the debt. This shows that money contracts usually survive changes in the institution holding them. A bank failure changes who manages the institution's assets and liabilities, but it does not automatically erase the borrower's contract. The legal relationship continues even if the institution itself is restructured or resolved. This is another reminder that money systems are built from formal obligations, not only from familiar names above branch doors. Contracts often outlast the institutions people associate them with. Brokered deposits are deposits placed through intermediaries rather than gathered directly through ordinary customer relationships. Because they arrive through a different channel, they may behave differently from local relationship-based deposits. The source of money can matter, not only the amount of money. Some funding is steadier than other funding under stress. Regulators treat brokered deposits carefully because they can behave differently from core relationship deposits in difficult periods. If money is less tied to stable customer relationships, it may move more quickly when conditions worsen. That can make funding less dependable. In banking, where money comes from can be just as important as where it goes. Institutions that are less than well capitalized face restrictions on accepting brokered deposits in the United States. This rule reflects the idea that not all funding should be equally available to weaker institutions. Stability is protected partly by limiting certain kinds of riskier funding behavior. Money rules are often designed not just for normal times, but for stressful ones as well. Consumer confidence in deposits rests on several layers at once, including supervision, liquidity management, capital, and deposit insurance. No single protection does all the work. Trust in money is often built from multiple safeguards standing together. When these layers hold, deposits feel ordinary and dependable. Cash and insured deposits are not the same legal thing, but both function as everyday money because the public trusts their usability. One is direct physical central bank money. The other is a bank liability supported by rules, institutions, and protections. Yet in everyday life, both are accepted because people believe they will work. Seigniorage is income. A central bank earns in connection with issuing banknotes and holding interest-bearing assets against them. This idea sounds technical, but it reflects a simple pattern. The central bank issues notes that usually do not pay interest to the public, while holding assets that can earn income. The difference can become a source of revenue. Because banknotes do not usually pay interest to the holder, central banks can earn income from the assets backing them. In a simplified sense, notes circulate as non-interest-bearing liabilities, while the assets held against them may produce returns. This is one of the unusual financial features of public money. The existence of cash can generate income for the issuing authority. Central banks can still face losses even though they issue money, because their expenses and the returns on their assets do not always move together. Issuing money does not make an institution immune to balance sheet pressure. The financial structure still matters. Even at the center of the system, money comes with accounting realities. Cash design matters because secure banknotes need anti-counterfeiting features to preserve trust in physical money. If notes were too easy to copy, confidence in cash would weaken. Security features help people recognize genuine money quickly and protect the currency's everyday reliability. The design of money is part of how trust is built into the object itself. The future of money may include central bank digital currency, but its design choices matter greatly. A digital public currency is not one simple idea with one obvious form. The way it handles privacy, access, resilience, and system impact could change what it means in practice. Designing money is never just about software. A retail CBDC would aim to give the public a digital form of central bank money rather than a private bank deposit. That distinction matters because most digital money people use today is a claim on private financial institutions. A retail CBDC would create a public digital money option for ordinary use. It would change the mix of money available in digital life. One attraction of CBDC is that it could bring the settlement finality and integrity associated with central bank money into digital use cases. In simple terms, it could extend some of the strengths of public money into a world that is becoming more electronic. That does not answer every policy question, but it explains why the idea draws attention. It offers a way to imagine digital payments with public money qualities. CBDC designers must balance privacy, resilience, accessibility, and law enforcement requirements rather than maximizing only one goal. Making digital money more private could complicate other objectives. Making it more controlled could reduce user confidence or convenience. The design of future money involves trade-offs, not perfect solutions. Account-based and token-based access are two broad ways digital central bank money could be organized. In one approach, identity and account relationships are central. In the other, the value may behave more like a digital token that can be verified differently. These are not just technical engineering choices. They shape how users would experience the money itself. Wholesale CBDC would be aimed mainly at financial institutions, while retail CBDC would be aimed at the general public. This distinction matters because the users, goals, and system effects would differ. A wholesale version might improve the plumbing between institutions. A retail version would change the form of money available to ordinary people. A digital euro, as discussed by the European Central Bank, is framed as a complement to cash rather than a replacement for it. That framing matters because many people still value the directness and privacy of physical notes and coins. The idea is not necessarily to erase one form of money in favor of another. It is to widen the forms public money can take. One policy argument for public digital money is monetary sovereignty, meaning a currency should remain usable and relevant, even as payments become more digital. If daily transactions move away from public money entirely, a country may worry about losing part of its monetary presence in ordinary life. Digital public money is therefore also a question of national monetary identity. It is not only a payment tool. Money also works through data, because modern finance depends on account histories, transaction records, and verified identities. What money is and where it moves are now deeply tied to information systems. A payment today is often both a value transfer and a data event. The records around money have become part of the money system itself. Personal financial data rights matter because consumers increasingly expect to move their financial information safely between providers. In modern finance, access to one's own data can shape competition, convenience, and control. Money no longer lives only in balances. It also lives in the information attached to those balances and transactions. Fraud in payments often targets access points such as cards, credentials, or account-to-account transfer tools rather than cash vaults. Criminals often go after the user-facing edges of the system where access can be tricked or stolen. That means modern money protection involves defending accounts and identities as much as guarding physical currency. The weak point is often the doorway, not the vault. Peer-to-peer payment platforms can be convenient, but complaints show that unauthorized transfers and fraud risks can still appear around them. Convenience does not remove the need for caution. Fast tools can sometimes move mistakes or scams quickly as well. The easier money becomes to send, the more important judgment and protection can become. The safer money feels in practice, the more smoothly people use it, which is why consumer protection is part of how modern money works. Protection is not only a legal side issue. It is part of the basic usability of the system. People are more willing to hold and move money when they believe errors and abuse can be addressed fairly. Money is not only an asset that people hold. It is also an infrastructure that societies maintain together. Payment systems, regulation, bank supervision, consumer law, records, and settlement processes all help give money its practical life. A balance may look personal, but the system supporting it is shared. Money works because society keeps that system running. Budgeting is the process of matching the amount and timing of income with the amount and timing of spending and bills. It is not only about reducing spending. It is about making sure money arrives where and when it is needed. Good budgeting helps money feel less chaotic because it creates a rhythm between inflows and outflows. Good money management is often less about mathematical brilliance than about coordinating timing, habits, and buffers. Many financial problems are not caused by misunderstanding complex theory. They come from small timing mismatches, repeated fees, or the lack of a cushion. Quiet routines and steady systems often matter more than cleverness. A household can earn a reasonable income and still struggle if bills arrive before income does and no cash cushion exists. This shows that financial strain is not always about total earnings alone. The sequence of money matters. Even enough money can feel like not enough money if it comes at the wrong times. Financial stress often increases when short-term cash flow problems force people into repeated fees or high-cost borrowing. One problem can begin feeding the next. A missed date can lead to a fee, which makes the next bill harder to cover, which can lead to more borrowing. Small timing pressure can turn into a larger money spiral. Overdraft events are often triggered by relatively small transactions, which shows how expensive timing mistakes can become. A modest purchase can create a fee that is large compared with the transaction itself. This is one reason balance management matters so much in everyday life. The cost of being slightly out of step can be surprisingly high. Fees matter because they remove money from the balance without creating any new asset or lasting benefit in return. A fee is often pure friction. It does not build savings, improve ownership, or increase earning power. It simply reduces what remains. Automatic payments can be wonderfully convenient because they remove the need to remember every bill by hand, and they can help keep life feeling smooth and orderly. But that same convenience also asks for careful balance management, because an automatic payment does not pause just because a paycheck arrived late or another expense came first. If there is not enough money in the account at the right moment, convenience can quietly turn into an overdraft, a missed payment, or a fee. In that way, even helpful tools still depend on timing and attention. Direct deposit can make money management feel much smoother by shortening the path between payroll and the account used for spending. Instead of waiting for a paper paycheck, cashing it, and then moving the funds, wages can arrive electronically and more directly. That reduces delay and can make budgeting easier, especially when bills are due soon after payday. Sometimes the simplest improvement in money management is making the path of money shorter and more reliable. Separating spending money from savings money can make both the practical and psychological side of money easier to handle. When the money for daily life and the money for future protection sit in different places, it can become clearer what is safe to spend and what is better left untouched. That structure can reduce confusion and temptation at the same time. In many cases, the organization of money is almost as important as the amount itself. Short-term money and long-term money often need different homes because convenience and growth rarely reach their highest point in the same product. Money needed soon usually benefits from stability and easy access, while money meant for the far future can often accept more risk and less immediate access in exchange for possible growth. The purpose of the money should guide where it rests. A wise financial setup often begins with giving each kind of money a place that fits its job. Money decisions are often path-dependent, which means one event can shape many later outcomes. A late fee, a missed payment, or one emergency expense can make the next month harder, and that strain can continue building if there is no room to recover. Financial problems often do not appear as one large event all at once. They more often grow through a chain of connected consequences. On the brighter side, one steady habit, such as regular saving, can also create compounding advantages over time. A small, repeated action can quietly improve flexibility, reduce stress, and strengthen later choices. Just as negative momentum can build from repeated setbacks, positive momentum can grow from repeated discipline. Money often becomes calmer, not through one dramatic move, but through many small good ones. Financial well-being is linked not only to resources, but also to a sense of control. The person may have some money and still feel unstable if the money arrives unpredictably, disappears too quickly, or cannot be directed with confidence. This is why money problems are often about instability as much as about totals. Security comes not only from amount, but also from steadiness and control. A person's balance sheet includes assets on one side and liabilities on the other. Assets are the things owned that hold value, while liabilities are obligations, such as debts, that must be paid. Looking at both together gives a fuller picture than income alone ever could. A balance sheet is one quiet way of asking what a person has and what a person owes. Net worth is the difference between what is owned and what is owed. It is a simple idea, but it gives a deeper view of financial position than one paycheck or one bank balance can provide. A person can earn well and still have low net worth if debts are heavy. Another person may earn less, but quietly build a stronger position over time by keeping more than they owe. Income, spending, assets, and liabilities interact constantly, which is why money management cannot be understood from one number alone. A healthy salary does not automatically mean strong finances, and a modest income does not automatically mean weak finances. What matters is how the pieces work together over time. Money is less like a single score and more like a whole living system. Borrowing for an emergency is usually costlier than using money already saved for that emergency. When a crisis is funded with debt, the original problem may pass, but the repayment burden remains. Savings, by contrast, can absorb the shock without creating a second layer of cost. This is one reason emergency funds feel so calm. They solve today's problem without borrowing from tomorrow. Financial products are easiest to compare when disclosures are clear, which is why regulation often requires standardized information. A person trying to choose between accounts, cards, or loans needs to understand rates, fees, and conditions in a form that can be compared fairly. Without clear disclosure, a product can look simpler or cheaper than it really is. In money matters, clarity protects judgment. A well-informed consumer is less likely to mistake a teaser rate, a fee structure, or a payment schedule for a better deal than it really is. Many financial offers appear attractive at first glance because the most pleasing number is shown most prominently. But real cost often lives in the details. Understanding those details helps money stay in service of the user instead of quietly working against them. Money works best at the household level when earning, saving, spending, borrowing, and protecting cash all fit together over time. No one part works as well in isolation as it does in harmony with the others. A household does not need perfection for money to feel stable. It usually needs a workable fit between incoming money, outgoing needs, and some form of protection. Money is both a private tool and a public system. Personal balances feel intimate and individual, yet the ability to use them depends on institutions, laws, payment networks, and shared trust that no one person controls alone. Every private transaction rests on a public framework. That is one reason money is so personal in use and so social in structure. A bank account balance feels personal because it belongs to one person or household, but behind that feeling sits a larger structure of bank regulation, payment systems, settlement rules, and consumer law. The number on the screen may seem simple, yet it exists inside a carefully built system. Ordinary money feels ordinary partly because that wider structure is doing its job quietly. The same dollar, euro, or other unit can play many roles in a single day. It can arrive as a wage payment, be used for a store purchase, repay debt, settle a tax obligation, or remain as savings by evening. This flexibility is one of money's deepest strengths. It is one tool that can move through many human purposes without changing its basic form. Money becomes more useful when it is divisible, portable, recognizable, and hard to counterfeit. These qualities may sound simple, but together they make everyday exchange much easier. A useful money can be broken into smaller amounts, carried through ordinary life, identified quickly, and trusted as genuine. Practical features like these help turn a currency into something people can rely on without much thought. Digital forms of money solve portability in one way, while cash solves it in another. Digital money can move over distance almost instantly through networks, while cash can move directly from one person to another without needing the banking system to be online in that moment. Each form carries a different kind of convenience. One depends on infrastructure, and the other can work quietly, hand to hand. The line between money and near money matters because some assets are very safe stores of value while still being poor tools for immediate payment. An asset can preserve wealth reasonably well, and yet be inconvenient to use at a checkout counter or in a quick transfer. That difference helps explain why economists distinguish between what is truly spendable money and what is only close to it. Liquidity changes the meaning of value. Money demand can rise during uncertainty because people value liquidity more when the future feels less predictable. In calmer times, they may be more willing to hold long-term assets or commit funds elsewhere. But when life or markets feel unstable, many people prefer to keep more money readily available. In uncertain moments, flexibility itself becomes something worth holding. That shift toward liquidity can itself influence banking, lending, and interest rate conditions. If people want to hold more easily spendable money and fewer longer-term claims, the broader financial system has to adjust. The preference for safety and access does not stay inside one household. It can change conditions across the economy. Individual caution can become collective financial pressure. A payment network without trust fails, but trust without settlement infrastructure also fails. Modern money needs both belief and machinery. People must believe the money is valid and will be accepted, and the system must also be able to move, verify, and complete payments reliably. Money works best when confidence and infrastructure meet each other quietly in the background. Money works across time by linking present claims and future obligations, which is why finance is so full of contracts. A loan, a lease, a salary agreement, a bond, or a pension promise all tie different moments together through money. It is one of the main ways people organize value across years. Money gives time a structure that can be measured and agreed upon. Money works across space by letting value travel farther than physical goods can travel conveniently. A payment can cross a city, a country, or an ocean much more easily than many objects can. That makes trade, support, and coordination possible at a distance. Value no longer has to remain where the object or the worker originally stood. Money works across institutions because one person's asset is often another institution's liability. The same balance can be security from one point of view and an obligation from another. This layered quality is one of the hidden truths beneath modern finance. Money is often held by people, issued by institutions, and supported by a web of promises between both. The creation of money, the movement of money, and the storage of money are related, but they are not the same process. One set of mechanisms helps explain how money comes into existence, another explains how it travels, and another explains how it is held over time. Treating them as one single process hides important differences. Money is a system with several kinds of action happening at once. Loans mainly help explain how much deposit money exists, payment systems help explain how that money moves, and savings products help explain how it is held through time. These are different functions inside the same monetary world. Creation, circulation, and storage each have their own logic. Understanding money becomes easier when these roles are seen separately. Inflation explains why the same amount of money can mean different real things in different years. A number printed on a paycheck or resting in an account does not carry the same practical power forever. What that money can buy changes as the general price level changes. So the passage of time quietly changes the meaning of money, even when the number stays the same. Exchange rates explain why the same amount of money can mean different things in different countries at the same moment. One unit of currency may stretch far in one place and less far in another, or convert into more or less foreign money depending on market conditions. This shows that money has both local meaning and international meaning. Its value is always partly relational. Interest rates explain why the timing of money matters so deeply. A dollar today and a dollar years from now are not economically identical because money in hand now can be spent, saved, invested, or protected sooner. Time gives money an extra dimension. Interest is one of the main ways economies express that difference in value across time. Deposit insurance and consumer rules help everyday money feel ordinary even though the underlying system is complex. Most people are able to buy, save, and transfer without constantly thinking about bank resolution rules or payment law. That calm is not accidental. It is supported by protections that help the system feel dependable at the surface. The more smoothly money works, the less people notice its infrastructure. That is part of why payment systems feel almost invisible when they succeed. A card tap, a transfer, a payroll deposit, or a cash withdrawal can seem simple because thousands of details are working properly in the background. Good monetary infrastructure often disappears into ordinary life. At its core, money works by turning trust, accounting, law, and time into a practical tool people can use every day. It is not just metal, paper, or digital code. It is a social technology built from shared belief and structured systems. That combination is what allows money to feel so familiar and so powerful at once. And when you look at it gently, money is not only about markets or numbers. It is also about how human beings organize promises, needs, plans, and protection across the quiet flow of daily life. It sits in the ordinary rhythm of earning, buying, saving, helping, and waiting. In that way, even money tells a story about how people live together. Some of the calmest lessons in money come from its simplest patterns. A little saved now can soften tomorrow. A payment made on time can keep later days lighter. A clear system can reduce worry before worry even begins. Often the most powerful part of money is not speed or size, but steadiness. Much of money's importance comes from what it allows people to do quietly over time. It allows food to be bought before hunger becomes urgent, rent to be paid before shelter is uncertain, and savings to stand ready before trouble arrives. It lets plans exist not only in the mind, but in action. Money becomes meaningful because it helps turn intention into structure. And yet the system remains delicate in its own way, because trust always sits at the center. If trust weakens too much, even complicated machinery can feel fragile. But when trust is supported by law, records, institutions, and careful design, money can move through life almost unnoticed. The quietness of that success is part of its beauty. In homes, in shops, in wages, in savings, and in distant transfers, money is constantly changing form while still serving the same basic purpose. It helps value move from hand to hand, day to day, and year to year. One moment it is a number on a screen, and another it is a settled obligation or a little reserve for the future. The form shifts, but the function remains. The deeper you look, the more money appears less like a thing and more like a relationship. It is a relationship between present and future, between saver and borrower, between household and institution, between trust and proof. The object itself matters less than the network of confidence around it. That is why money can be so simple in use and so rich in meaning. And for all its complexity, money often comes back to a few quiet human needs: to exchange, to compare, to save, to prepare, and to feel a little more secure about what comes next. Under the layers of policy, finance, and infrastructure, those needs remain remarkably familiar. The grand system exists because ordinary life keeps asking for it. Money serves the everyday. There is also something reflective in the way money reveals time. It shows how present choices reach into the future, how habits build consequences, and how stability is often made from many small, repeated actions. Money is never only about the moment in which it is held. It is always carrying a little of the past and a little of what is hoped for later. So much of financial calm comes not from having every answer, but from understanding a few gentle truths well. Timing matters. Buffers matter. Clarity matters. Trust matters. When those things are respected, money becomes easier to live with, even if it never becomes perfectly simple. Even the invisible parts of money deserve quiet appreciation. The payment rails, the account records, the settlement systems, the protections, and the rules rarely ask to be noticed. They simply keep life moving. Their success is often measured by how little interruption they bring into ordinary days. And perhaps that is one of the most restful things to understand about money. When it works well, it does not need to be dramatic. It can remain in the background, supporting routines, protecting plans, and letting people focus on living rather than constantly thinking about the system itself. Good money often feels quiet. So as this gentle look at money comes to rest, what remains is not only the machinery of banks, payments, rates, and records, but the simpler idea beneath them all. Money is one of the ways people carry value through time, across distance, and between one another. It is a practical bridge made of trust, structure, and shared understanding. And now the numbers can soften a little, the systems can grow distant, and the ideas can settle into stillness. The accounts, the payments, the quiet promises, and the careful records can drift into the background where they usually live. And you can let the whole story of money grow lighter, calmer, and farther away as the night becomes simple again.